Welcome to FXTech's comprehensive analysis of the CAD CHF currency pair for the period of October 13th through 18th, 2025. This report is prepared on October 20th, 2025, and provides an in-depth examination of technical patterns, fundamental drivers, and actionable trading strategies. Over the next several slides, we'll explore the bearish trend that has dominated this pair, analyze the key factors influencing both the Canadian dollar and Swiss franc, and present our outlook for the coming weeks. Whether you're a short-term trader or a position holder, this analysis will equip you with the insights needed to navigate the current market environment with confidence. Three major themes shape the CAD/CHF landscape during October 13th to 18th. First, Canadian economic headwinds. The Bank of Canada maintains a patient approach with rates on hold until clearer disinflation trends emerge, while markets are pricing one additional 25 basis point cut by year-end 2025. Tariffs continue weighing on employment in manufacturing, wholesale, and retail sectors. Second, Switzerland's safe haven strength. The Swiss National Bank held its policy rate at 0.0%, with guidance unchanged, and rates are expected to remain on hold through 2025 and 2026. The Swiss franc benefits from defensive positioning amid global uncertainty. Third, fragile global growth. Policy caution prevails across major economies. U.S. regional data shows stark divergence, with Empire State at positive 10.7 versus Philadelphia Fed at negative 12.8, and China's persistent disinflation with CPI at negative 0.3% year-over-year and PPI at negative 2.3% year-over-year. During the week of October 13th to 18th, several critical developments shaped the CAD/CHF landscape. The Canadian dollar faced significant headwinds from disappointing employment data, which showed a loss of 14,500 jobs in September, far below expectations. This weakness was compounded by escalating trade tensions between the United States and Canada, creating uncertainty around future economic cooperation. Meanwhile, the Swiss franc benefited from its traditional safe haven status as global risk sentiment remained fragile. The Bank of Canada's dovish stance, signaling potential further rate cuts, contrasted sharply with the Swiss National Bank's more stable policy outlook. These diverging monetary policies and economic fundamentals set the stage for continued CAD weakness against the CHF. The technical picture for CAD/CHF has turned decisively bearish. The pair broke below the critical support level of 0.5700, which had acted as a floor for several weeks, confirming downtrend acceleration. This breakdown is significant as it validates the bearish Elliott Wave count. According to FX Pro's wave analysis, we're currently in downward impulse wave 3, with the next target at 0.5600. The chart displays strong sell signals across all time frames, from the 15-minute chart all the way to the daily and weekly perspectives. The 50-day moving average has crossed below the 200-day moving average, forming a classic death cross pattern. Resistance is now firmly established at the 0.5700 to 0.5750 zone, and any rallies toward this area should be viewed as selling opportunities rather than signs of trend reversal. The Canadian dollar faces multiple fundamental headwinds. The unemployment rate has risen to 7.1%, reflecting labor market weakness. Manufacturing PMI stands at 47, indicating contraction in the industrial sector. The Bank of Canada has already delivered multiple rate cuts this year, with the policy rate now at 3.25%, and markets expect further easing ahead. The trade environment presents significant challenges, with U.S. tariffs impacting employment across manufacturing, wholesale, and retail sectors. Canada's GDP growth has been sluggish, and as a commodity-linked currency, the CAD remains vulnerable to weakness in oil prices. The combination of weak domestic data, dovish central bank policy, and external trade pressures creates a perfect storm for CAD weakness. This fundamental backdrop supports our bearish technical view on CAD/CHF. In stark contrast to Canada, Switzerland presents a picture of stability. The Swiss National Bank maintains its policy rate at 0.0% with no immediate pressure to adjust, and rates are expected to remain on hold through 2025 and 2026. Swiss CPI stands at just 0.2% year over year, reflecting well-anchored inflation expectations. The Swiss franc's safe haven status continues to attract defensive flows amid global uncertainty. BNP Paribas forecasts euro to Swiss franc to maintain around 0.94, indicating expectations for continued franc strength. Switzerland's economy, while modest in growth, remains resilient with low unemployment and political stability. The franc benefits from Switzerland's strong fiscal position and its role as a defensive currency during periods of market volatility. This fundamental divergence between a weakening Canadian economy and Switzerland's stability provides the foundation for our bearish CAD/CHF outlook. Our short-term outlook for the next 1 to 2 weeks maintains a strong bearish directional bias. The primary price target sits at 0.5600, which represents both a key support level and the completion of the current Elliott Wave structure. We expect the pair to trade within a range of 0.5600 to 0.5680 during this period. Any near-term rallies should be capped at the 0.5700 to 0.5720 resistance zone, providing tactical short entry opportunities for traders. The bearish momentum remains intact as long as the pair trades below 0.5750 on a daily closing basis. Key catalysts to watch include Canadian employment data, CPI reports, and any developments in US-Canada trade negotiations. A break below 0.5600 would open the door to further downside towards 0.5550. The recommended strategy is to sell rallies toward resistance with tight stops above 0.5750. For the midterm outlook spanning 1 to 3 months, we present 2 scenarios with different probability weightings. The primary scenario, which we assign a 70% probability, envisions continued weakness in CAD/CHF. This scenario assumes that Canadian economic data remains soft, the Bank of Canada delivers additional rate cuts, trade uncertainty persists, and the Swiss franc maintains its safe haven bid. Under these conditions, we expect the pair to trade within a range of 0.5550 to 0.5650. The alternative scenario, with a 30% probability, involves stabilization and potential recovery, requiring easing of trade tensions, positive Canadian data surprises, risk-on sentiment, and a pause in BOC rate cuts. The critical pivot level is 0.5700, which serves as the key decision point. A reclaim of this level signals trend reversal, while failure confirms bearish continuation toward our downside targets. Several risk factors could influence CAD/CHF in either direction. On the downside, 4 key risks support the bearish view. First, escalating trade tensions with further deterioration in US-Canada trade relations. Second, weak Canadian data showing continued softness in employment and growth indicators. Third, additional Bank of Canada cuts with more aggressive easing than currently expected. And fourth, global risk-off sentiment driving increased safe haven demand for the Swiss franc. On the upside, 4 risks could challenge our bearish outlook. First, trade deal progress with a breakthrough in US-Canada negotiations. Second, Canadian data surprises with stronger than expected economic indicators. Third, a risk-on rally reducing demand for defensive currencies. And fourth, SNB intervention, either verbal or actual, to weaken the franc. Additionally, 3 geopolitical factors warrant monitoring: Ukraine conflict developments, China-US trade relations, and Middle East tensions affecting oil markets. Here's our disciplined trading approach. The primary bias is short CAD CHF. The optimal entry zone is 0.5700 to 0.5720, representing the key resistance area. place your stop loss at 0.5760 to protect against adverse moves. The initial target is 0.5600, with an extended target at 0.5550 for those holding longer-term positions. Maximum risk should be 2% of account capital per trade. Before entering, wait for technical confirmation. Rejection at the 0.5700 to 0.5720 resistance zone. Bearish candlestick patterns. Volume confirmation on downside moves, and note that the trade is invalidated if there's a daily close above 0.5750. Risk management rules. Maintain strict stop-loss adherence. Avoid heavy positions in a single entry. Scale in on multiple resistance touches. Take partial profits at 0.5640 and 0.5600, and never exceed 2% account risk. Monitor Canadian CPI and employment reports, Bank of Canada rate decisions, US-Canada trade negotiations, SNB policy meetings, and global risk sentiment indicators. In conclusion, 5 key takeaways define our CAD/CHF outlook. First, technical breakdown. The pair broke critical 0.5700 support, confirming downtrend acceleration and providing a clear bearish signal. Second, fundamental divergence. Weak Canadian fundamentals, including poor employment data, manufacturing contraction, and trade uncertainty, contrast sharply with Swiss Franc safe haven strength and SNB policy stability. Third, central bank policy. The Bank of Canada's dovish stance with expected further rate cuts versus the Swiss National Bank's stable policy at 0.0% favors Swiss franc appreciation. Fourth, our short-term target of 0.5600 is based on Elliott Wave analysis completion and represents a logical technical objective. Fifth, the bearish bias is maintained while trading below 0.5750 resistance, which serves as our key invalidation level. The confluence of bearish technical signals and negative fundamental drivers creates a compelling case for continued depreciation. Traders should focus on selling rallies toward resistance while maintaining disciplined risk management. Thank you for watching this FXTech analysis.